All right, so let me zoom down to this section. All right, so our first piece, I think, is the year in review, right? We're going to kind of do a review of what happened in the Biden administration so far. And the way that Carl and I do this is we think of his starting month, sort of month zero is January. So that's sort of the initial number that we use, and then we compare against that. And then with that's for monthly numbers. For quarterly numbers, we're using the first quarter of 2021 as sort of period zero and going from there. So we do not have 4 quarters of Biden yet. We've only got 3. We got sort of the change from Q1 to Q2. So Q2, Q3, Q4. Only 3 periods of sort of to evaluate Biden from a quarterly perspective. So we'll clarify that as we get into it, but that's sort of how we've done some of this math. So let's take a look at the summary page for a second. This is where Biden started in January of 2021. And then we have the latest figures for January of 2022. And I've got some notes in there where some of these numbers don't fit into those buckets quite as well because they are quarterly, or in the case of the budget deficit, we're talking about a forecast for this entire fiscal year. So that's a little weird, but let's look at it. So because many of these we've covered already, so I'm not going to spend much time on them. The jobs level's up 6.6 million, 4.6%. And I'll give you some historical context on these numbers as we get through some of the other slides. The unemployment rate has fallen to 4%. The number of unemployed has fallen by about 35%. The real GDP level is up about 0.75 trillion, sorry. So the economy is about 3%, 3.9% bigger than it was in January of 21. Inflation, you can't really compare these, like adding or subtracting these two doesn't make a ton of sense. But if you look at a year before what was happening, the prices over 12 months came up about 1.3% in January of 2021 versus January of 2020. And then they were up 7.5% January of 2022 versus January of 2021. So don't get into this number very much here. Wages are up $1.74 an hour, or almost 7%. So if you think about inflation being up about 7.5%, wages aren't very far behind, as we talked about. Real wages have not fallen very much under Biden, and they actually are well up. I think it was almost 3 percentage points when you compare against the pre-crisis time period. We talked about the budget deficit going from about 2.8 trillion, this is billions, 2.8 trillion down to about 1.2. Almost a 60% drop in the budget deficit. That's huge. The stock market is up about 17%. And then the debt held by the public is up about 1.9 trillion since January, about 8%. So pretty good jump here in that initial time frame. This is a calendar year figure, and this is a fiscal year figure. It makes a big difference. All right, so that's kind of the high level, sort of everything on one page. And so let's analyze this a little bit. This is sort of just the text version of what I just gave you. So let me highlight a couple things. An unemployment rate of 4% is lower. It's been higher 84% of the time in our history. It's only lower 16% of the time than that, going back to 1948. So that's an 84th percentile, if you will, unemployment rate. So if you say, how good is the economy? You're saying, yeah, it's B, 84th percentile. That's pretty solid. That's kind of what the unemployment rate means. The job creation, even though we're still recovering, which is certainly true, it's the fastest job creation from the start of a presidency ever. It's slightly faster. Well, let me not say ever. Among the last 8 presidents that I looked at, Carter to present, it is the fastest among those. He's just a hair faster than Carter. Carter had the record for fastest gains in jobs out of the gate of any president until Biden. And 550,000 a month is very solid. Those of you that have been with Carl and been in this group for a long time know that 200 to 230,000 is a pretty solid job creation. So 550 is a pretty serious number. And the GDP growth is very fast. if you compare fourth quarter of 20, so technically that's a period back earlier than Carl and I would normally think is the right way to analyze it, just so you get a year in there, for 5.5%, fastest since 1984. And then, the 6.9% quarterly growth rate annualized in the last quarter is a extremely fast growth. But also bear in mind, as Carl mentioned, the economy has never been as big as it is now. It set the record. It regained the record level in the second quarter of 2021. So the third quarter growth added to that, and the fourth quarter growth added to that. Because you'll sometimes see people argue, well, we're recovering, and so growth is going to be faster. That may be true for the job creation because we're still recovering. We're not quite back to the pre-crisis level, but that's not true of GDP. This record quarter was on top of record level GDP already. The stock market increase has been very dramatic. From election, so from November of 20 to November of 21, the stock market was up 37%. That is the fastest of presidents going back to even before World War II. So that's a presidential record for the first year measured from election. We didn't end up that way. It was 17% from inauguration to the end of January, also very, very solid. And then, when you have statistics like that, with housing up 15%, the net worth of Americans is going to be, during the Biden administration, we're seeing the records being set for the richest America has ever been in real inflation-adjusted terms. Wages are growing fast. We saw those numbers. They're almost as fast as inflation, which I think of as the key way to look at it. Are wages faster or slower than inflation? Because that tells you on average whether purchasing power is getting stronger or not. And what we're seeing here is under Biden, a little bit slower. Against the pre-crisis, wages are up a lot more. And then we talked about the budget deficit. Here is, we call this format, the bill format. He loves to rub this in the noses of the Trumpers to explain, you guys aren't as great as your propaganda would encourage you to believe. So the unemployment rate dropping off, jobs up, stocks way up, hourly wages up, real GDP in record territory up, budget deficit falling like a rock. That is a very nice looking economy. I will take those numbers, even with some inflation. But, we got to win that marketing battle. People are very keyed up about inflation, and you have to come up with good ways of explaining these in dollar terms people understand. So we'll get to the slide on that pretty soon. In other words, taking these aggregates and what do they mean for a family in dollar terms. This is the 550 monthly average job creation. And we're comparing Biden, just his first year, against all the years of these other presidents. So it's a little, I won't say misleading, it's simply understand that in the way the analysis is done. Biden's only got a year, the other people have several. But still, good start. Gives you some perspective on, Clinton and Carter had very healthy, some very strong job creation in that 200,000 range. Biden's more than twice that so far. This shows, this is the number of months in office, but you got 0 all the way out to 96 months a president could be in office, 8 years times 12, 96. And so where was job creation relative to where they started as a percent increase or decrease? And so Biden is up 4.6%, those 6.6 million jobs. And he's right there. He's a hair above Carter. And few people realize Carter is the defending champ in terms of at least his first term. The cumulative increase in job creation was very strong under Carter. He also faced inflation. Here's Clinton, the 2-year defending champ. Reagan behind him. Trump started off very, very well, sort of in third place for a long time, and then boom, down he went, and he ended up negative. So he has the worst measured throughout his entire term. And you can see some others. The Bushes didn't do very well. They had very mediocre job creation. And then Bush 43 was lucky he sort of ended when he did, because you can see, if you see the start of Obama down here, down to the bottom, this sort of green line then becomes this. He got out just in time, or he would have had negative job creation as well. Somebody sent a slide. I saw it on Twitter, but I haven't verified it yet. they said something like 90-something% of job creation in the last 30 or 40 years has been, since Bush won, has been under Democrats. Because Bush 41, Bush 43, and Trump all had crappy job creation. So if you take Reagan out of the puzzle and you start after him, you get Biden, Carter, Clinton, and Obama. And that's probably how they did it. The job creation, take Reagan out, everything post-Reagan, it's all Democratic job creation. Republicans have had almost none, which I thought was really fascinating, but you can see it. Take Reagan out and you don't have a whole lot. Here's Bush 43, Bush 41, and Trump. Trump kills off, basically this negates Bush 41, and then Bush 43 barely had any. So I love that. That's better. Not lying with statistics, but it's one of the best pieces of engineering in terms of making a message. And I may have to check how they did it and see what I can come up with. But I liked. There's a nice way of what's the term for that? How do we call that? What's that word? Yeah, we were definitely selective statistical usage there. Here are GDP growth by president, and this is that 5.7 that Biden's using. I used 5.5. There's different ways of measuring this, and I think, Carl, did you want to jump in now, or you want to wait until the end of the section to kind of go through the details of how this is done?
I don't know. Do you want to finish the section? I'll come back to why I think this is a misleading chart.
Sure. Yeah, we'll do that. All right. Let me mention it first. So in terms of, these other ones are all throughout their entire terms in office. You got Clinton as the defending champ under this measurement approach, and then Biden is now the champ, at least for his first, 4 quarters. And I think they're using, you might have to clarify this. I'll leave it to you when you get into it, where this 5.7 comes from. I looked at just where we were, the size of the economy in the fourth quarter of 2020 against the fourth quarter of 2021. That's where you get a 5.5% number. Okay. The 5.7 is something
I'll explain it in my
all right
thing. So,
stock market. This is that record that Biden set, 37.4% from election. And remember, we usually don't. Carl and I don't normally start tracking presidential performance at least till they're elected and have until they're inaugurated and can actually write policy. The argument that Trump made was, because the stock market was going up a lot after he was made president, he was saying, it's a leading indicator. It's a reflection of all the great policies I'm gonna bring in. And so the big jump that he had between his election and his inauguration, he took credit for. So fine, let's keep doing that. So Biden's elected in November, and boom, market jumps. And it's been jumping until recently, until early, I think December, early January, it started to drop a little bit. But he has that record, and here's all the other presidents listed here. I don't have it in this presentation. We've got it in the one about how the Democrats outperform Republicans, but it's somewhere around 4 percentage points a year on average that the stock market outperforms under Democrats. It's like 11 for the Democrats and 7 for the Republicans, if I remember right, in a typical year. This is the line from election also, so you can see it going up and down, but even from his election to February 11th, he was up 31%. So even this recent drop, I think it's dropped a little more since then, but not a ton. He's still up quite a bit from when he was elected. This is good news on the ACA exchanges and also on the number of uninsured. The storyline here is, the Affordable Care Act got passed, but it wasn't really till 2014 that you saw the full implementation. And so you see this drop off, and sort of probably other things going on in the economy, just recovering and more people able to afford health insurance happening in here. But then 14 to 16, that's where you see the impact, 14 to 15 in particular, of the Affordable Care Act. Then Trump comes in, starts kind of sabotaging things and making it harder to use the Affordable Care Act, getting rid of some of the outreach programs and helplines to help people sign up. And so people didn't use it as much. And for 2 years, for 3 years, but after these policies went in, you had these 2 years really where it started climbing a lot. And then it came back in 2020 when even Trump passed a lot of these relief acts under COVID, the programs, the CARES Act, was helpful in getting the ACA exchanges running a little better. And then in 2021 through the first half, that's what that H means, we also saw the number of uninsured fall. Along with that, I don't have a chart for it, but 15.5 million people signed up for the ACA exchanges in 2022. That's a record. I should probably have what the record was before that, but I think it's at least 1 million or 2 million, might even be 3 million above where it was. I think it was somewhere in the 12s, and now it's in the 15s. So a lot of people signed up, and that's due in part, or due mainly to the, I think, Biden's Relief Act and the outreach programs that went with it, but also expanding some of the eligibility criteria. So good news there on that front. What's interesting, yeah, go ahead.
I was going to say, what you're seeing in those early years, you have to remember that in the recovery from the Great Recession, we're adding about 2 million jobs a year or more, 2.5 million jobs a year. And so people were getting health insurance through their employers and reducing the number of uninsured that way. Right.
No, that's right. One thing that surprised me when I saw this, if you look at the 30.8 million uninsured, somewhere in the 30 million range is a good measure to keep in mind when you look at the next slide. And they've got 27.4 is the number they're using. But this is the Kaiser Foundation. I always tell people, if you're interested in learning about a particular subject in healthcare, when you search, just type Kaiser and then type whatever your question is. And they'll get you to a study on that subject that's written in English that usually has great graphics with it. Kaiser is a phenomenal resource to understand these subjects. But the bottom line here is that over half of the people that are uninsured are actually eligible for some help. Either they can get really cheap insurance through the ACA or they can get Medicaid. And so they've got, they look here, 25% Medicaid ship eligible, marketplace subsidy, that's the exchanges, the Affordable Care Act, 38%. So it's 54 when you have the 53 plus, yeah, almost 54% can get help. And they don't know that. And that's why the outreach programs are so important to say to people, hey, you guys are probably eligible. And I don't know to what extent letters get sent to these people's homes or called or what. I don't know how that works, but there's a lot of general advertising I'm aware of, and there are call centers that can help you, but I don't know how much targeted stuff. I don't know if anybody's ever received targeted communication on this, but it's a big opportunity to let people know you can get this stuff pretty cheap.
Yeah, if you sign up for the newsletters in Chicago of your aldermen or your state reps or your U.S. rep or U.S. senators, they'll always include information about signing up for insurance and what the sign up periods are. If you wanted insurance by January 1, you had to sign up by December 15th. If the drop dead date was January 15th to get insurance by February 1st. I've gotten information that way. I don't get early years, you'd see somebody setting up a table in front of a grocery store or something, but nobody's doing that in the era of COVID, et cetera.
So this is more detail. I had planned to summarize this, but I just left it, sorry. But the monthly checks, this is part of the Relief Act, Biden's Relief Act passed earlier in 2021. This child tax credit was expanded and more people were eligible and increased the dollar amounts a little bit. So you started getting these $250 or $300 per month checks coming to your home or wired into your account, ACH'd into your account. And so you got that for 6 months. And then when you file your tax return in April, you'll get the other 6 months of benefit in there. So you'll see in the news, like this article saying, the program's over, that the monthly check part of it is over, but you'll get the other 6 months of benefit when you file your tax return. So if you're not someone who always files your tax returns, you have and you've been getting this, just make sure you file your tax return. But there are some interesting statistics on the impact of this child tax credit. In the second paragraph, child poverty rates fell from 17% in February to 12% by the end of the year, so a third. And 3.7 million children out of poverty and reducing child poverty rates by 30%. I think there's a food might not be in here, but there's okay, here you go. 24% drop in hunger for families connected to the Biden tax credits. And there's a link to another article in there. I didn't go there, but you can take a look at it. It made a huge difference. So if you're saying, was a particular government program impactful? Because there's always a lot of debate about, okay, we spent this money, what do we get from it? We got a lot from this plan. It helped a lot of families get through this crisis, but also get a lot of kids fed and get them out of poverty. So this is something that Manchin stopped because it's part of Build Back Better to expand, to continue this, and he did not support Build Back Better. I'm not sure where Sinema ended up on that one, if it was both of them or just one of them, but Manchin usually gets the credit for torpedoing the extension of this one and others. AOC did a nice tweet, really throwing him under the bus on that one. She really let him have it, which he deserves richly, I think, for this one. But this would have been a great program. And as you know, we've talked about the budget deficit impact of this thing was minimal because it was funded, it was paid for by tax hikes. And we've covered this in a couple of prior meetings. So when Manchin said it's going to bump up the deficit, that's really not true. He also said it's going to bump up inflation, but if you're not really affecting the deficit, you're unlikely to have much impact on inflation. And as we talked about, you should be skeptical of the idea that it was the government spending doing it anyway, because it's energy driven to a lot of extent and it's in Europe. So he just made up a bunch of arguments that didn't make any sense. And, he just thought that would help him, I guess, in some way, or he owed somebody, one of his constituents, to keep them from, I think it was probably just to keep the taxes from going up for some of his donors, I suspect, but we shall see. It's only a hypothesis. The president's got a serious approval rating problem. This data was from January, but while he's lost about even 15% approval among Democrats, from 98 to 82, so 16%, which is serious. He's got the independents are almost cut in half, and the Republicans were always near zero anyway. So I mean, losing 5% there is kind of a gimme. But these two should be concerning. And your guess is as good as mine. I don't have any special talents on this one. This seems to me progressives getting disillusioned with not getting Build Back Better, but it was consistent. It wasn't just here recently with that revelation. It was falling steadily throughout his administration. Is it inflation? Is it Afghanistan? I mean, most Americans usually don't care too much about what happens overseas. It isn't something that really moves the dial. So this, I'm guessing, is Build Back Better. But this stuff here could just be general, the virus and other issues thrown in there. But the independents, my theory there is that the independents are sort of like, they didn't want to admit that they were Trumpers, but they're really happy if they can find a Republican Party that's more normal. And so I think they're really throwing Biden under the bus here. They were probably this is probably an artificially high figure, but I didn't look at it going back 20 years. So I'm not sure if this normally happens or if this is something unusual. The Gallup study didn't have a lot of insight there. So I guess I'll throw it out to you guys. Any insight you guys have on why the Democrats or independents have really seemed to throw in the towel a little bit? What do you guys think?
I've seen and I've heard people complain that Biden didn't keep his promises, that he promised to do these things. And they never mention that there's Republican obstructionism and that he's got two members of the Democratic senators that are holding it all up. They never mention that. They just say, well, he's not meeting his promises. That's what I hear.
I mean, one thing I remember, and I think the June bump up in approval ratings was when Biden was saying, "Hey, we're past COVID. We can start to open things up this summer." And then Delta showed up, and his approval ratings dropped with Delta in the summer. And then it looks like, whether it's August or September, that Afghanistan and our withdrawal from Afghanistan happened, that he took a hit at that point as well.
I'm with Charles on. I believe that the expectations were unreasonably high. I think the media has really beat the inflation issue to death. And even though it's a worldwide issue, it's been focused on the US. And of course, I think that we can't ignore the impact of COVID and the stress on all of us as a result that nobody can be really heroic in this circumstance.
Yeah, I mean, Biden kind of promised that we're going to get the vaccines and that's going to take care of COVID. And it didn't exactly happen because a number of people didn't get the vaccines. And even the people who got the vaccines, some of us, some people still got COVID. As I say some of us, but I'm vaccinated and I'm in that group that never have gotten COVID yet. I say yet because I spend 4 to 5 days a week in a classroom of Chicago high school students. About, 60% of the high school students are vaccinated. About 60% of the high school students wear their masks up over their nose and mouth. Except when they're eating, because the schedules are really weird. And so people are eating, breakfasts and lunches in the classrooms.
Yep. No, those are all very good reasons. I mean, one thing we'll go through is list of accomplishments here and some materials that you can share. But this is a guy who's been in office for a year. He's passed $3 trillion in legislation. You got the 1.9 from the, 2.9. So 3 trillion in legislation. It's about 2 from the Relief Act and then another trillion for the infrastructure bill. And then all these other metrics we've covered are very strong for the economy, except inflation. The amount of negativity in the news is amazing. There was the chyron that was on the screen for ABC over the weekend when they did their Sunday programs was inflation crisis. And they had these Republican pollsters in there talking about why everybody hates Biden because of the inflation crisis. And it's like, this is the kind of thing that, you shouldn't, with an economy this good, see numbers like this. It should be better. And so that's why I think we have a lot of work to do in terms of marketing the good things that are happening, because there's a real negative feeling out there that people seem to have. So, all right, let's keep going. All right, Carl, I guess before I do the next section, you want to jump in and do your presentation on the GDP
Yes, I'll share my screen. Yes. David showed an interesting graphic of GDP growth by president, sourced to the Bureau of Economic Analysis. And it's true that the underlying data for this chart does come from the Bureau of Economic Analysis, but it's created by somebody over at the White House because the Bureau of Economic Analysis, to my knowledge, has never done any calculations about GDP growth by president. And this is using the annual numbers for GDP growth that the the Commerce Department's Bureau of Economic Analysis publishes. And let's just say that they should never be used for doing GDP growth by president. A lot of people have this misunderstanding that the annual GDP growth numbers for a year are for the calendar year from the beginning of the year to the end of the year. And that's not true. So this slide is apparently from the White House misusing the annual GDP growth rates. Biden is the 2021 rate. Trump is the average of the rates from 2017 to 2020. Obama is the average of the rates from 2009 to 2016, et cetera. And again, while the underlying information is from the Bureau of Economic Analysis, they never attribute GDP growth to presidents, and the calculations behind this graphic are misleading at best. Annual GDP growth rates are not calendar year growth. They're more or less growth from a little before the middle of one year to a little before the middle of the stated year. So the 2021 GDP growth from about the second half of May of 2020 to the second half of May of 2021. And that's, so that's kind of really more Trump was in office more of that period than Biden. And so that's one reason why it's misleading to use that as a Biden number. Also, quarterly GDP numbers are not end of quarter numbers. They're actually weighted to the first month in the quarter. For instance, the first quarter GDP number for a year, the level, is 1/9 of the November number, 2/9 of the December number, 3/9 of the January number, 2/9 of the February number, and 1/9 of the March number. So that's how the weighting goes to the first month of the quarter, which is why we typically use the first quarter number as a January number for when a president takes office, because the first quarter number is actually weighted to the first month of the quarter. To give you an idea of where that 5.7% comes from, these are the quarterly real GDP levels as reported by the Bureau of Economic Analysis. And so you take the 4 quarters for 2020, get an average, take the 4 quarters for 2021, get an average, divide the two numbers, and you get 105.67% or 5.67% growth or 5.7% growth. And that's how that number is determined. But again, these are not beginning of the year numbers to end of the year numbers. That's why the fourth quarter, if the quarterly numbers were into the quarter numbers, makes sense. But when the quarters are really beginning of the quarter numbers, first quarter to first quarter is the best measure of a year under a presidency.
That's really a good slide, Carl. I think that seeing the math of sort of the average of one year compared to the average of the next year is the growth in that second year.
Yeah.
And that's a really good way to explain it. It brings it home. When you're reading how people are talking about that measure, watch out. Also, economists will often use the Q4 to Q4 comparison, and that's where that 5.5 number came from that I was using earlier. You'll see that. Sometimes you just have to look at how they're really doing that.
So as we just demonstrated, the Bureau of Economic Analysis calculates the annual GDP level by averaging the level of the 4 quarters in a year. Because the 4 quarters are weighted towards the first month of a quarter, the annual average level is essentially an end of May number. So the annual growth rate for 2021 was the 2021 May average divided by the 2020 average. So the 2021, in quotes, growth rate of 5.7 is a combination of the Trump and Obama years. And if anything, is more of a Trump number than an Obama number. But if you use the methodology in this graphic, it attributes most of the Great Recession of December 2007 to June 2009 to Obama, not Bush, even though most of the negative quarters occurred under Bush. One more reason why you don't want to use the methodology in that. Okay, as we've talked about, there's no perfect measure of GDP growth by president, but the best measure appears to be from the quarter a president takes office. Typically, we've gone from the first quarter of the quarter a president's inaugurated to the quarter a president leaves office. For Trump, that's the first quarter of 2017, ending with the first quarter of 2021. So a total growth of about 6.5% over 4 years, which is a compound annual rate of about 1.6%. And that's how we get to the 1.6% for Trump that we see here, 2.1% for Obama, 1.8% for George W., 3.7% for Clinton, 2% for just over 3.4% for Reagan, and just under 3.4% for Carter. When people talk about stagnation under Carter, when his GDP growth was as high as Reagan's, it's kind of silly, but yeah. But you can compare these numbers to what was in the White House charts. Trump and Obama take a hit under their methodology. The Bushes and Clinton get a boost, and Reagan takes a hit under the methodology that the White House used. So the bottom line on this is be careful of numbers if you don't see the calculations, because even though we would like to think the White House would lie to us, they provided some misleading information. Lying means
lying with statistics.
Although lying implies that they actually know that they were providing misleading information. It's kind of like, does Manchin know that the deficit's being cut that much?
Sad that he might not. But yeah, that's just that chart you just showed. And I do this most of the time. Sometimes I forget, but it's the you should say source, not you, Carl, but a person doing an analysis like the White House did should say source data, because the source of the graphic and the numbers is not really the BEA. It's the source of the data they were using, but that's a different thing, and they should be careful with that.
Yeah.
Now,
So
did
under
you hear
President
this? There
Biden,
was
we have 3/4 of growth totaling 3.9%, which we've seen before. If we continued at the same rate, this would equate to an annual growth rate of 5.3% through 4 quarters. A lot of economists are expecting lower growth in the first quarter of 2022 because of Omicron. So the first year is going to be lower than 5.3%, but the quarter is still expected to be positive. So we'll see growth of higher than 3.9% for the full year. Absent a recession, I expect real GDP growth under Biden will be strong, possibly exceeding 3% annual growth over 4 years. We got a long way to go. But to go back to one of our prior charts on this, if we looked at annualized real GDP growth rates by president, something in the 3.9% would put him, just behind Kennedy and Johnson and ahead of Clinton, at least for that first year versus their full presidencies. What we see is that Reagan had decent growth. Ford and Nixon didn't have terrible growth. You also see that in general, growth has been slowing as we've gotten to more recent time periods. That Trump, Bush, Obama are all lower growth. And a lot of that has to do with the fact that the labor force has not been growing as fast as it did during the earlier years. We had better population growth in the early years, and a huge factor through 2000 was the increase in the workforce participation rate for women, which went from somewhere in the 30% range up to 60% in 2000. But this is where you see that on average, Dems have had about not counting Biden, the real GDP growth rate under Dems is about a full percentage point higher than under Republicans. And it's one of the reasons why the economy, by a lot of measures, has tended to do better under Democrats. And as we get more people working, we get higher tax revenues and lower expenses for supporting people, because not as many, if your income goes up because you get a job, not as many people. Anyhow, that was my warning about being careful about data that you see, and don't believe everything you see, even if it comes from the Biden White House. So I'm done.
No, thank you, Carl. Thanks, Carl. That was great. There was a funny, there was a mess up that the Biden administration did, or they were kind of cheating, where they actually manipulated the vertical axis on one of his charts and put it was 1, 2, 3, 4, 5, and then they put 5.56, and they put them at the same separate distances, meaning 1, 2, 3, 4 were all up to 5 were all the same distance, and going to 5 to 5.5 was the full and then the 6. And so people circled it and were all highlighting it on Twitter. It made it into the Washington Post. It's like, why are you doing this? This is great growth. Why play with the graph? Just do it. It's just, I don't know. Our marketing needs a little work. So we are part of that process of trying to fix it. All right, let me share my screen here. When you are talking about economic numbers, people will often think of, we talk about aggregates, unemployment rate of 4%, GDP growth, but what do these policies mean? And what do they really mean in dollar terms that a normal human can understand easily? That's what this slide does. And I've been sharing this like crazy on Twitter and trying to get some notice on this from our powers that be on the Democratic side. These are some figures. You got a $1,400 check, 250 to 300 checks per month per child. Median checking accounts are up about $500 over a normal level that they were in 2019. A lot fewer children in poverty. Record ACA signups. Now, then you get into wages. Wages up 7%, $1.75 an hour means $3,500 or so for a family. For an individual. That's a nice number. I've seen the Republicans using a number about that size for inflation, how much inflation has cost people, and wages have basically kept up. So here's the other side of that. The stock market is up a ton. There are some statistics from Fidelity through the second quarter that show that the average 401k balance is up about $25,000. Now that was the year ending Q2. We'll see what happens for year ending Q4. It might not be all that different because of the way that the market jumped right after he was elected, but still, it's going to be a significantly higher number. About 50% of Americans own stock directly or through their 401k. So it's helping half of America that the stock market is jumping. And then housing prices are up about $50,000 for the average home, about 14%. And about 2/3 of families own homes. 2/3 of households own the home that they live in. So when you're talking about what this means Americans are getting, if you have a 401k, if you're the average 401k holder and you have the average price home, you are up $75,000 since Biden took office. And that is tens of millions of families. And you're up $3,500 if you have the average wage. And you got the checks. Most families, 80% or something, got the checks and are getting the child tax credits. Well, more got the checks than the tax credits, but still, I think it's about 60 million families, I believe, are getting the child tax credit, and that's per child. So if you got 4 kids, you get some serious money coming in. So these are ways of thinking about dollars that are coming to people. While yes, stocks are owned by the top 10%, own about 90% of the stock. 50% of Americans have a stake in this, and the average retirement account balance is somewhere in the 100,000 range. Has gone up to more like 125, 130,000 in that year ending the second quarter. So these are things that you can trumpet as Democrats. Interestingly, when I've done that for housing prices, people say that's a negative, like it's bad. And I'm saying, if you own a home, it's not bad. And that's 65% of families. But Democrats and Twitter, for example, Twitter is predominantly a younger group, and the younger group is more left than the typical family. They don't like the fact that the housing prices are going up because it's pricing them out of being able to buy a home. So are you going to not say it? That's a political calculation. But to me, if housing prices are up 50,000 and 65% of families own the homes, you should be talking about it. But that's why they have polling. But these are some ways of thinking about the numbers in dollars that normal people can understand. So I wanted to just cover that with you. You have this slide, and we always give you the links at the end where you can just grab them easily, share them on Twitter or the Wikipedia or other news articles that are handy to share to make the kinds of points that Carl and I are making today. Although I have to say I have not run across an article yet that is like, here's all the awesome stuff that happened under Biden from an economic standpoint. If any of you has that, send it to Carl or me, because I'd like to see it. It's like nobody's bothered to do it, and I don't understand. I look around and I've not seen it. All right. So
maybe as a relevant question to the housing, is there any reason to believe that any of this is being driven by inflationary fears? Because obviously you don't want to hold cash during an inflationary period. And how homes have historically been, with the exception of that big crash we had a decade ago, have been generally, though, over the last century, have been a good place to hold money.
In most markets.
What?
I said in most markets.
In most markets, agreed. And you got to live somewhere.
Well, if you followed certain retirement hotspots like Phoenix, Florida, Vegas, they've had a lot more ups and downs.
Yeah, I would expect. But in any case, is there any home or real estate investment? I'm thinking of not real estate as in downtown skyscrapers, that is being driven by, and if so, what percentage, by sheltering money from inflation?
I think a lot of it has to do with calculating a mortgage payment. And when mortgage rates were under 3%, not that long ago, people could afford the price of an extra $100,000 on their $300,000 home, because the mortgage payment, the interest rate was so low, the mortgage payment worked out to the same amount. Where now, as you're seeing, people getting 3.84% mortgages or whatever they're getting right now, the cost of buying the actual cost of buying a home is going up, which should put an end to a lot of the upward pressure on housing prices as people have to pay a lot more for their homes now.
Well, and following on that logic, if you can borrow money at 3%, but homes are escalating in value at more than 3%, that seems to be a pretty shrewd investment.
Yeah, if you believe that homes will continue to escalate,
Big if, yeah.
Just like it was a great investment back in 2006, 2005.
Well, and frankly, I'm surprised, given from what I understand our demographics are. As was pointed out earlier, we aren't making as many babies per capita as we used to be. So you don't have a next larger generation that needs to buy and build a new home. So I don't understand what's really been driving the housing market as it has been for the last decade or two.
Well,
But
one
that's
thing
another question.
that's recent, and I think Mark Lundholm pointed out, what you had when 22 million people lost their jobs was a collapse in the housing market, people being able to afford homes, apartments, moving back home with their parents, et cetera, et cetera. And so builders stopped building new homes, new apartment buildings, wondering when demand would catch up. And as those, 19 million of the 22 million have gone ahead and gotten jobs, they're now looking to move out of their parents' basement. And they're finding that the availability of housing to both buy and rent is much lower. You also have a number of people at the higher end that are going ahead and, getting a second or third, or I don't know, how many homes did McCain have? 7, whatever. Buying extra homes around the country at what appear to be relatively cheap prices, especially at the borrowing rates, and then hoping that they'll make a profit on them before they sell, and at least they'll get to enjoy their homes a couple of weeks out of the year.
All right. Let's finish, and then we can, if there's any time left, we'll do we can do an open session and reminisce about missing Lou Malnati's pizza. But I'll do the Cliff Notes because we're late here. I don't want to take too much more time.
Okay.
This idea, the sector balances, and we've been talking about MMT the last couple of meetings. Most of what I'm going to share here is not controversial, meaning this is just the math of how these things work. And whether you're an MMT economist or a traditional economist, you're going to have the same view. I mean, these are basics that they take as a given. So these aren't things that are particularly, again, controversial. I'll let you know when we get to the controversial stuff. But let's explain how this works. This is what are called sector balances or sector accounting. When you think of the way, if you learned or ever took an accounting class, the formula is assets equals liabilities plus equity. A equals L plus E. And that must always they must equal each other. Assets equals the sum of liabilities and equity. If they're not, that means you did the accounting wrong. You made an error. Because of the system, the way it's designed, they must always balance. You followed the rules. And here, same idea. When you look at the 3 sectors, there's a government sector, there's a foreign sector, and there's a domestic private sector. And I'll explain on the next slide kind of the caveats and simplifications I've made here. But I'm using the government budget, the federal budget deficit for government. Technically, you would use local government as well in that figure, but that's a harder number to get. So we use the federal government. The foreign is, you're supposed to use the current account, which we don't have the full year balance yet. So I'm just using the trade deficit, which is most of it. It's probably 85% of our current account is the trade deficit. We talked about the trade deficit earlier, imports less exports. And then domestic private is sort of the plug number. It's going to balance out so that these 3 things add to 0. And that's the private sector. What each sector means is that area adding net worth or losing net worth? In other words, is it lending or borrowing? And so the easiest one, I think, for this group to get their brain around is the government. Federal government, we all know, has a big deficit. Last year was about 12% of GDP. And we also talked about the trade deficit, which came in at around 3.7%. And since we're talking about the foreign sector, the way you look at it is the trade deficit times -1. It's the negative of it. You look at it from the foreigner's perspective. Do they have a surplus relative to the U.S. or not? We have a trade deficit, so they have a trade surplus with us net, meaning we have a trade deficit with the world. They have a trade surplus with us. And then the domestic private is technically savings minus investment. But for this calculation, we'll use it as a plug number just for simplification. When you add up, if you look at any vertical point on there, those three numbers always add to 0 as a matter of accounting. There's no ifs, ands, or buts about it. That's what they do. Otherwise, there's a mistake has been made. And once we have the current account, we'll go through that in a more formal way. I've done that in the past. We do this about once a year. So if you look at this trend a little bit, what we had here, this green line, the way an MMT economist would look at this, now we get into some more of the controversial stuff about what's the right policy to run. The MMT economist says the government puts money into the private sector and it takes it out when it spends, and it takes it out when it taxes. And so what you generally want is a small or at least a private sector surplus. You want the private sector adding to its wealth, adding to its net worth. And if you're running a little bit of a government deficit to do that, that's fine. The way this works in the United States, because we have a foreign surplus, a trade deficit, from the foreigner perspective, they have the surplus of pretty sizable. We have to run a budget deficit at least that size to have a domestic private sector that is a positive number. Because remember, these three things must add to 0. So if you are running a big deficit, you can have a surplus here and a surplus here. But if this government deficit falls below 3.7, assuming that foreign number stayed the same, you would then be putting your private sector into deficit. And what we had here from about 97, the end of the Clinton administration, we had the trade deficit, and we also had the budget deficit actually went into surplus for a little while. And that was forcing the private sector into a deficit. And they ran a deficit for a long time, from 97 until 2009. And as you know, we had a series of recessions, and under Bush, we had a sort of a jobless recovery. It was a very weak economy throughout here for the most part, not really at the end of the Clinton piece, but as we got in here, the economy really went sort of downhill. And then eventually the crisis hit and the government deficit then exploded, and that drove this private sector surplus up quite a bit. So it had to, because if the deficit is suddenly gigantic, the private sector is going to be in surplus, assuming not a big change in the foreign. But this was dangerous. And there were economists that follow this, that work on this sort of thing, that were warning, some of the few that were warning ahead of the 2007 to 9 recession, ahead of the Great Recession, warning, this is dangerous. If you keep this up, we're going to get into trouble. They couldn't tell you when. They just said, you're running a private sector deficit. Private sector is getting more and more indebted. That's bad. And so that is kind of how you think about sector balances is we want, and notice here since then we've had the green has been positive. It's a little bit negative here, but for the most part, positive and then strongly positive in the last few years. And you've seen the stock market going up, the net worth has been jumping. It's been there's been a lot of money getting transferred from the government into the private sector this last couple of years with COVID. But generally you want this green line slightly positive. And if you're going to run a foreign surplus like this, then your deficit has to be at least that size. So if I asked you the question, how big should your budget deficit be? The rule of thumb would be as big as your foreign surplus, or at least offsetting your trade deficit. You can think of the trade deficit as money leaking out of the U.S. economy. You got to put it back in with the government deficit if you're going to run it. And so that's what this kind of high level means. This is defined, I've just defined these terms here in more detail for you. I won't go through all this because it's late, but you can read it. And I put the caveats down here about technically the government sector should be state and local in addition to federal. The foreign sector is really what's called the current account, which includes interest coming back and forth, not just the imports and exports, but also financial flows like income on investments that foreigners own or that we own. Those are generating interest and dividend payments. That's part of that current account. But for our purposes, it's very accurate. This is not going to be far off the final result because the federal government is overwhelmingly where the money is getting spent. That's where the big deficit is. And then the foreign sector, the trade deficit is a really big part of that account. So we're not that far off by using the methodology that I gave you a minute ago. In fact, the CBO uses a similar one. They use the federal government budget deficit, and then they use the current account, and that allows them to plug in this domestic private figure. This is another way of looking at it of government is spending money into the private sector, taxes are taking money out, and then payments for imports and then also interest to foreigners is going out, and then receipts for exports and investment income is coming back in. And so this is kind of how the money is flowing between the three sectors, but the formulas down here must hold true by definition. These will always net out. So each one has different implications, but again, the goal is have a little bit of you want that green above zero. Doesn't have to be this high above zero, but you want it in here. And this is where that last few years of the Trump administration was kind of Goldilocks. We had a fairly small budget deficit at the end of the Obama administration, a small, a little bit bigger deficit under Trump, a little bit bigger private surplus, and a pretty constant foreign sector surplus. This was pretty good for the United States. And those last few years before the pandemic were solid economic time period. And so I'm trumpeting this here because when you hear the government talking about budget deficits, we always think of the budget deficit as bad. And I've just explained why you've got to have a budget deficit that's at least as big as your trade deficit so that you're not draining money out of the private sector. And so I wrote this tweet, and Warren Mosler liked it. And Warren Mosler is like a god of MMT. He's like he's like the guy that practically invented it. He's the man. And there's a couple others like him, but he's one of the gurus of this thing. And so I said this. I said, just wait until the media says we had a $3 trillion private sector surpluses in fiscal year 2021. Now Biden's cutting that to $1.3 trillion. Why is he doing that? So an MMTer looks at this very differently from a regular person and is saying, it's good. It's a good thing for the government to run a budget deficit. You should do it with some control on it. You don't want to drive inflation or have other problems, but you should be talking about things in terms of what's happening in the private sector. The private sector surplus is what matters, not the government budget deficit. And in fact, the deficit's a good thing if that's what you need to keep your private sector in surplus. And so that's why he liked this, because this is sort of, once you think that way, you've sort of arrived at kind of the MMT thought process. And so some of the additional detail is down here. You want to add to the private sector wealth. That means a budget deficit as big as our trade deficit. Same private sector deficits are bad because you're draining the private sector is becoming more indebted. You don't want to do that. That's what happened before the Great Recession. The constraint on what the government can spend is inflation. The government doesn't need, as Christine was explaining the last couple of meetings, the government doesn't need to get tax revenue to have dollars to spend. All it has to do is legislate it, and the Fed can create the dollars and pay the money. The Fed will pay whatever the legislation tells it to pay. It doesn't have to say, well, we don't have tax revenue. It just says, fine, we'll pay it. And then, how will we pay for spending on something isn't the right question because we don't need to pay for it. It's the right question is, what should we be spending on? Should we be Medicare for all? Or what do we need to do to make sure our people are not starving, are not hungry? You figure out what really matters, you pay for it, and then if you get inflation, you take action. And I've said this before, and some MMT guys I've been following corrected me on this. The MMT solution for inflation is not just raising taxes. There's also the idea of expanding the supply, meaning for labor, you could get a lot more immigrants in to address, if you were getting inflation because of wages driving it, you could bring in more labor. You can invest in capital, and you can also invest in technologies or skills that give you more productivity. So I had always said, well, they may raise taxes. it's not just about the deficit. There's also this supply side, and MMT people are starting to explain that more, because the people that understand MMT a little, like me, thought about it as only raising taxes, but they're like, no, there's a whole supply side to this, not the Republican supply side, which just means cutting taxes generally for the rich. It's real supply side economics. How do you expand labor and capital and improve the productivity of the economy? That's real supply side economics. So this is the Cliff Notes version of the sector balances. And you can study this presentation. There's also I don't know if I have it here or not. Sector balances is down there toward the bottom. I worked a lot in that Wikipedia article, so you guys can use that as a reference for understanding some of these concepts are explained there if you're interested in it. But just wanted you guys to have that as sort of a foundation of some of the logic that you've been hearing, some of the descriptions of things from Christine in the last couple of meetings. So I'll stop there.
So to speak a little bit more on the MMT speak, the trick is you need to pay attention to things that are real. So we want to pretend that exports are good and imports are bad. Well, what's an import? Oh, we get something real. We get a car. What did we give in return? We gave a token. We call them dollars because we're in the United States. So we got a car for a piece of paper. In fact, not even a piece of paper, for an entry in a bank account, probably at a bank in New York. So we got something real for something that's a record in a computer. Because our federal government creates these accounts and can manipulate these accounts, every time we take money and want to turn it into a treasury bill, where did that money come from? Well, by definition, it had to come from the federal government. There are very limited reasons to borrow money to go buy a treasury. I mean, the financial people can pull that off sometimes. But for the most part, if you have a dollar bill that's not going to expire, right? You didn't get it on a loan, then it had to come from the federal government. That's the only source for it. It's the only thing that can issue a dollar that doesn't expire. Well, what would you invest with? Oh, you have to use a dollar that doesn't expire. Every dollar in treasuries ultimately has to be sourced from the Fed, or from our federal government. It's just so fascinating. So if the dollar into the T-bill came from the federal government, what's the net? It has to net to zero. It has to. Again, accounting identity. So our federal government cannot run out of money. It just can't. It's like saying a movie theater can run out of movie tickets. It's a nonsensical thing. You don't want our federal government to run a surplus. Goes in, takes money out of your checking accounts for what? Are we going to take a car from today and ship it back in time to pay for the car or to replace the car that we bought 50 years ago? It's meaningless. So, yes, MMT is a wild change in perspective. The fundamental change in perspective is the federal government has monopoly right to create money. It's right there in the Constitution. When it creates high-powered money, that money doesn't have to expire. It can be burdened. So again, you can tax it and destroy it. You can entice people to trade it for a T-bill so they can't easily spend it. Can you stop the federal government from spending the money? No. When we have a war, suddenly the federal government finds the money to spend. We did it Civil War. We did it for the Spanish-American War. We did it for World War I. We did it for World War II. How many different examples do we have to have that when we, as the government, want to spend the money, we invent the tokens and go spend it? Again, the only functional thing is and we probably may be experiencing it, right? The Fed, the equivalent of the Fed in Europe, the equivalent of the Fed in Japan, and our Fed spent a decade trying to increase the inflation rate and couldn't do it. Federal government spends a bunch of money into the economy, suddenly there's inflation. Wow. How much more powerful is fiscal policy versus monetary policy, right? Because if the Fed invents the money, it's a loan. It's a loan by definition. They're a bank. You don't want the federal government to run a surplus. A balanced budget for a federal government, again, states are not federal government, is just taking money out of our pockets for no useful reason. A human being needs to save money, right? We have a future, we need to eat, things happen. Does a movie theater save movie tickets? No. Why? Because they print them on demand. They are a monopoly for movie tickets. Federal government is a monopoly for money, for the US dollar. It fundamentally really is that simple. For every dollar that goes to buy that real thing from that foreigner, someone has to invent the money to do it. You either get short-term money by borrowing it from a bank, or you get long-term money by getting the money from federal purchases. It is fascinating. Another thing to think about is pretty much everything's a trade. The trick is realizing how many little trades are happening. And once you realize almost everything you deal with is a trade, you can start realizing all these signatures and all these documents are really just accounting for trades, right? You pass a check. My check happens to have the word Chase on it. What is that? That is a document from a bank. Bank is authorized by our federal government to recognize that the federal government will recognize money created by Chase. Isn't it fascinating? So that if I send a check with Chase's name on it to the Treasury, they'll cash it. What will they do with the check? They'll burn it. Well, they used to send it back to my bank where, again, where I would eventually, in olden days, would keep the check and then I'd burn it, right? Once a check's done, is there a reason for the token anymore? And it's amazing the history of fiat-based money has been around for hundreds and hundreds of years once you recognize what they were. Every time you say, we were on the gold standard. No, not really. There's really hasn't been a functional commodity currency. It just hasn't.
All right. Good. No, this is great perspective. I think we should end our official session. If there are more questions, go ahead, bring them up. We went a little late tonight. We're almost at 10, which is a few people that made it through the end. Good for you. Hopefully you learned some good stuff tonight and can use it to spread the word.